to this results presentation. Welcome to this results presentation for the year to 30th of June 2021. I must say I'm pleased to say that we can congratulate Michael Sassoon and his team on a really good set of results. The group has fortunately returned to profitability after our clients were severely impacted last year by COVID-19 and the associated lockdown. We've experienced good performance in the asset finance and wealth pillars in particular, and this despite a very fragile economy, tough business environment, and the fact that most of our staff were working from home. The ratios are going in the right direction. The cost to income ratio and the credit loss ratio both improved, as did the return on equity. But most important, from a governance point of view, our capital adequacy ratios have also continued to improve. So all this means that we are now able to reinstate the dividend, which I'm sure will be very welcome. And we've also been able to invest further into our distribution channels. If I may go back into history, when I joined one of my employers, my chairman was Donald Gordon, the founder of Liberty, and he said to me, distribution is the key to success in financial services. So Michael and the team have been investing heavily in distribution, and we also have investing in our business banking pillar. The group also undertook a lot of corporate actions this year. As you will hear from the presenters in a few minutes' time, was the repurchase of the preference shares, the sale of our interest in the Efficient Group, and the closing down of Sasfin Asia, and a few more. So overall, I think it was a very successful and productive year. You'll also noted from the announcements that we issued a few minutes ago that this is my valedictory results announcement. Grant Dunnington, who's the longest serving director, together with myself, we've both been on the board for 9 years. So sadly, we will be retiring at the AGM at the end of November. I must say, I'm going to miss Sasfin. I can say it now, I can brag as I depart, but it's a great company with a great board, great management, and probably most importantly, great staff. I'm pleased to say that we found a very good successor for me. He will succeed me after the AGM at the end of November. He's been a chairman of a bank before. He's been on our board for a full year, and he is, of course, Dion de Kock. I look forward to introducing Dion more fully at the annual general meeting. Let me now hand over to Angela Pillay, our finance director, who will introduce the panel of speakers, and thereafter she will take you through the numbers. Thanks, Angela.
Thank you, Chair. Good morning, ladies and gentlemen. Before I spell out the order of proceedings, please be reminded that you are welcome to raise questions on the chat, and we'll try to address them during the course of the presentation and at the end. The results presentation and booklet are also available on our website. To run through the agenda, you've just heard from the chairman of our board. I will take you through the full group results and will hand you over to Linda, our CE of Asset Finance, Errol, the CE of Sasfin Wealth, and Michael, the Group CE, who will take you through the pillar reviews, and Michael will close off with prospects and questions. Moving on to the financial results. As the Chair alluded to, it has been a strategic focus of the group to streamline and simplify our business model. In the last financial year, we have entered into several transactions in this regard and have made meaningful progress towards achieving our strategic objective. Before going into the detail of the numbers, it's important to contextualize our results in light of these transactions and the impact that they have had on both our income statement and balance sheet. On this slide, we look at the income statement transactions, the results of which are all outside of our headline earnings numbers. In the Efficient Group, we reported in our interim results the sale of our 21% stake in the Efficient Group. This resulted in an increase in our income of 21 million and profits of 11.9 million. This transaction was recorded in our wealth pillar, and Errol will allude to it in his presentation. The sale of commercial solutions. We sold 100% of our subsidiary in this business, as we no longer thought the business was core to Sasfin's operations. This resulted in a small loss to the group. On the impairment of intangibles, we performed an assessment of our capitalized software, and due to changes in scope and implementation approach on strategic projects, this caused a change in use of these assets, which resulted in a total headline impairment of just under 41 million. And then lastly, on Sasfin Asia, we moved our foreign trade business to South Africa and wound down our Hong Kong operations in May 2021. This resulted in a loss of control of the entity and hence a deconsolidation from the group. The headline earning loss resulted in a net loss to the business of 30.2 million. On this slide, we look at the transactions impacting our balance sheet. The repurchase of the preference shares. Sasfin Holdings entered into a scheme of arrangement to buy back its preference shares for 136 million rand. The deal became unconditional prior to year end, resulting in a liability to preference shareholders. This was recognized outside of share premium, and our share premium declined by the 136 million, resulting in a 43 million rand on our balance sheet. The liability was settled post year end, and the remaining 43 million will be realized through a transfer to ordinary equity in the new financial year. The purchase of Sasfin shares by the share incentive scheme. The share incentive scheme purchased 1.4 million of shares for 40.1 million. In anticipation of a share incentive scheme, which is currently being designed to align executive interests to those of the shareholders of the group. On consolidation of the share incentive trust, this portion of shares will be a reduction to group equity. The impact of these streamlining initiatives resulted in our headline earnings for the year being 141.1 million, up from the loss of 48.6 million in the prior year. The key drivers of our profit for the year can be attributable to total income increasing by 11.65% to 1.3 billion for the year. Net interest income grew by 6.25% on the back of improved margins, specifically in the asset finance business. The healthy growth in non-interest revenue of 16.5% is from improved performance across all our pillars, most notably increased mark-to-market valuations in our specialized lending portfolio. These loans are well secured and linked to profit share arrangements that are fair valued at through the profit and loss line. Included in our non-interest income is the sale of our efficient business. The stake is in the headline earnings adjustable item, and if we exclude this income, our headline earnings adjusted total income grew by 9.85%, slightly down from the 11.65 reported. On our credit impairments, we had a healthy decrease by 40.35% to 150 million for the year. The result of this decline in impairments has resulted in an improvement in our credit loss ratio to 75 basis points from 303 basis points last year and 102 basis points in 2019. Included in the credit impairment charge of 150 million is an increase in our ECL of 98 million on the land bank bills held by the group. There's a separate slide on the ECL impairments, and I'll take you through that detail when we get there. On the operating expenses, our expenses increased by 5.88% for the year. Employee costs increased by a mere 2.49%. Due to our prior year losses, there were no salary increases in the main. The group has, however, made several investment hires, mostly concluded in the second half of the year. The cost associated with the deconsolidation of Asia Limited, the impairment of our intangible assets, contributed to the 5.88% increase in costs. Excluding these items, our cost growth would have actually been a reduction in costs of just under 1% for the year. Together with increased income, the cost to income ratio improved to 77.95% from 82.2% in the prior year. Excluding the headline earnings adjustments that I've just spoken about, and which are unlikely to occur in the future, the cost to income ratio would have been 73.36%. The effective tax rate is quite high at 43%, primarily due to the non-deductible expenditure arising from these headline earnings adjusted items. This slide shows the movement in our headline earnings over the period and separately discloses the financial impact of the transactions I've just spoken about on our performance. And on a headline earnings adjusted basis, just to reiterate, the total income has grown by 9.85%. The headline earnings costs have come down by just under 1%. And the positive jaws results in an improvement in our total cost to income ratio of 73.36%. On the financial performance, in here you're having a look at the long form income statement. Having regard to what I've just said, the group profits have increased to 77.64 million from a loss of 43 million in the prior year. To touch on just one or two line items that I haven't spoken about in the previous slide. Associate income has come down slightly due to the sale of the associate in Inefficient. There is no preference share or non-controlling interest in the current year due to the preference share buyback, as well as the sale of HRS administrators in the prior year. On our ROE, there has been an improvement, a significant improvement since the prior year as we return into profits. However, our ROE is not at the levels that we would like it to be. However, the transactions we concluded during the year was to optimize the group structure and to improve our capital structure. The changes made are expected to increase the group's future earnings on a sustainable basis and thus expected to contribute to the future growth of our ROE. On the CTI basis, on a 5-year trend, we have added an additional line showing the impact of the transactions that we've just concluded. And the difference of the 4.59% being the 77.95 and the 73.36, these adjustments are not expected to recur in the new financial year. And we are on track in terms of our ongoing streamlining initiatives across the business. On our financial liquidity and capital position, moving to our balance sheet, our overall financial liquidity and capital position is stable and well managed. Our core funding comprises deposits from customers, debt securities issued, long-term funding, and bank overdrafts. The funding contracted by 2% to 8.2 billion, primarily due to customer deposits declining by just under 8%, which was offset by just under 100% growth in long-term funding to 730 million. Net available cash comprises cash and liquid negotiable securities, offset by funding under repurchase agreements and our bank overdrafts. This metric has remained largely flat over the year at 2.3 billion. As you will see later, the decline in cash and liquid negotiable securities is offset by a similar decline in funding under repurchasing agreements, keeping the net available cash flat over the year. Our liquidity coverage ratio is well above our regulatory minimums. Gross loans and advances have grown by 1.24% to 7.25 billion, and with our stage 1 exposure up by 4%. This is largely due to an increase in credit lending experienced in the second half of the year. Given our stable and well-managed financial liquidity and capital position, and together with our improved performance, the board has declared a final full dividend of 30% of headline earnings. This results in a dividend per ordinary share for the year at 131.02 cents versus 48.89%. It's worth noting that our 2022 dividend is only an interim dividend. On our financial position, the total assets has declined by 13.22% over the year. And as mentioned before, this contraction is driven by a decline in cash and negotiable securities as a result of the group's decision to reduce its funding under repurchase agreements. As mentioned, there is a compensating decline on the liability side. Going through to the ECL impairments, the total exposure on amortized loans and advances for the year has remained flat at 6.9 billion, with a 3% decline in our ECL at 535 million. To set some context to our ECL, the results from our annual recalibration of our model yielded an increase in overall PDs based on the inclusion of additional 6 months of COVID-impacted loans, the general decline in LGD given the very improved collection efforts, and on the forward-looking information, despite the fragile economy, the economic factors did indicate a scalar that is less severe than what was applied in the prior year. The increase in stage 1 exposure is due to an uplift in the lending activities, particularly in the second half of the year and from the rental finance business. This corresponding coverage percentage decreased primarily due to the impact of the improved forward-looking indicators. The stage 2 and stage 3 exposures have declined year on year due to a significant impact of the improved collections, as a large portion of our clients who went into arrears during the first lockdown have now brought their accounts up to date. In addition, there were some meaningful settlements in our stage 3 accounts, which were previously fully provided for. And lastly, in line with our credit policy, there were exposures fully written off where there were no reasonable prospect of recovery. The ECL in stage 2 increased from 38 million to 44 million due to an increase in the PDs from the recalibration of the model. This resulted in our coverage ratio increasing by 49% year on year. The ECL in stage 3 declined as a result of the settlements and collection efforts, with the coverage ratio increasing by 10% year on year. Overall, we have a better quality book, with 85% of our exposures being in stage 1, and the improvement in ECL is very much a function of the improvement in the staging of our book. On our ECL graph, you will notice the 75 basis points is at the lowest point of our 5-year cycle. However, the credit coverage ratio is only marginally down from 7.96 to 7.71%, evidencing that our book is appropriately provided for. On the liabilities and equity slide, as mentioned earlier, our funding under repurchase agreements has declined due to our group decision to reduce activity in these instruments. Deposits from customers have declined year on year due to, in June 2020, and I'll show you in the next slide, a spike in the deposit book. We had a spike in the deposit book leading up to June, and there was a decline thereafter. Some of our clients moved their funds offshore. The decreasing interest rate environment saw some of our maturing fixed deposits migrating to higher yielding classes. However, this was in line with our business as usual expectations. There were, however, some unscheduled NCD withdrawals, which were not replaced due to the strong liquidity position of the group at the time. Finally, if you go further down the slide, you'll see a 96.67% increase in long-term funding, and that we've increased our DFI monies as our amortizing loans have come down. On this slide, you will notice that there was a spike in deposits from customers in June 2020. However, barring this spike, the deposit base has shown an upward growth over the 5-year period. The capital adequacy of the group has improved over the period due to a decline in risk-weighted assets, as our credit RWAs have come down during the year due to the benign growth in our loans and advances. The onion graph shows the pillar contribution to the group's operating profit for the year. I will hand over to Linda, who will start the conversation on the pillar performance. I will, however, talk you through the group services. The increase in losses within the group services is a function due to the accounting I've just spoken about of the streamlining of the business initiatives. Throughout this presentation, we've heard about the loss on the deconsolidation of Sasfin Asia, 30 million, the impairment of the intangible assets, and also in addition, the additional provision in negotiable securities. The total of these movements accounts for 170 million of pre-tax losses. As you cast your eye over the key features of our results, which I have spoken to, let me close by reiterating. The group had undertaken streamlining initiatives to ensure the focus on core business and to optimize our capital. The return to profitability is off the back of strong revenue growth and a significant decline in credit impairments. And finally, the financial liquidity and capital position of the group remains stable and well managed, with a growth in loans and advances, an improvement in the capital adequacy ratio of the group, and a stable net available cash position. This has allowed the board to declare the final dividend of 30% of headline earnings for the year. I thank you for the time, and I'll now hand you over to Linda, who will take you through the asset finance performance.
Good morning to all stakeholders. I'm very pleased to be sharing the asset finance results with you. I only wish it could be in person. I think maybe it's better because I think I might get too excited in person and the computer makes it more professional. I think it would be good to start before I share the numbers with you, to explain the journey of our new business and the impact of COVID-19 and the recovery of the impact of COVID-19. If you look at this graph that we're sharing, you can see a huge, stable, consistent growth of new business and asset finance since 2017. And then you can see a strong start in 2020 in the first half of the quarter, achieving just short of 1.6 billion. And then the second half, and the second half of 2020 and the first half of 21, you can see the impact of COVID-19 on our business. And you can, and also if you look at the top green line there, you can look at our approval ratio on the deals that we receive. So during that period, our approval ratio dropped to 50%, starting to recover in 2021, which showed us we had to take a more conservative credit approach to what was happening in the economy, while still trying to support and look after our clients. Okay, Angela, the numbers. You can see the asset finance total income improved by 9.27%, up from 2020 to 579 million. This was mainly due to the benefit of lower prime, better margins, good quality clients, good credits, and a very strong quarter in 2021, a huge recovery. If you look at if you go back to the graph, don't worry, Angela, you'll see we had an exceptionally strong quarter in 2021, which actually shows us the recovery of the South African markets and the team taking us back to pre-COVID times of 2019. This was assisted and benefited by a huge effort and focus, with a strong focus on our collections and credit team. Strong team, strong focus, which brought our impairments down by 81.78%, down to 36 million from 198 million in 2021. So just also just very special thank you to the collections and credit team. Asset finance couldn't have done it without you. Showing a net income after impairments of 543 million, up to 63.57% from 2020, while still containing our costs, reducing our costs by 3.48%, showing incredibly pleasing, I would say more than pleasing results of profit of operations of 289 million versus against 68 million in 2020, up 319 and 62% increase on the previous year. Okay, Angela. Okay, so just I think I mentioned most of these points on the slide, but I'd just like to say it was an incredibly difficult year to achieve those results in a year of where there was so much There was so much turmoil in the economy, so much pain from people around. So we worked very closely with our clients. We had the empathy to not say, okay, it's all about Sasfin, let's do what we have to do. So we did find a big portion of our time was spent working with our clients, offering them payment holidays. We did over 800 million of payment holidays in the worst of the COVID time, relief loans, refinance solutions, and which also assisted in terms of the overall performance of the division. Where to from here? It's going to be very difficult to beat these results next year, but with the team and the clients I have in place, we are cautiously optimistic, even though it is tough times. Our clients remain foremost, and the reason for our success of the division is because our entire belief and focus is on client service and delivery. We've got a very stable team, and we need to ensure that we attract and retain our top talent in our team. We've got staff that the average staff is over 15 years with our team, so they're skilled, they're knowledgeable, and they're committed to the business. We've also seen, due to a lot of companies starting to work from home, and this hybrid model starting to emerge, and the change in the way businesses operate, that a big portion of our book is still office automation. We continue to focus on that, but we've realized the need to properly diversify. So we've invested in some specialists because we're not specialists in everything. So we've employed an ICT specialist, we've employed a software specialist, a specialist in renewable energy, and we want to focus and grow the books in that area, which we do think is the future. We continue to digitize our business and deepen our credit curve, because our business is about our clients and it's about credits. And we're very excited to say that we've launched a credit scorecard. You won't see the impact of it just yet because it's still rolling out, but it will transform our business. And the other day, we had one deal approved in 15 minutes on the credit scorecard. So it really is transformational, and we continue to invest and continue to improve our service delivery to our clients, which includes the speed of how quickly we go to market. Very exciting and very close to my heart is that through our offering through Nasera, the South African economy needs some help. We need to employ people. We need to do and Sasfin needs to do what it can do to assist that growth. And so through Nasera, we are now offering finance for SMEs, women, youth-owned businesses to get on the feet, and not just only the funding line to support them. So it'll be from asset finance to revolving loans, but also technical support and getting these companies on their feet so we can truly make a difference and help South Africa grow and get out of this economy slump. And we continue to work closely with our clients and for big focus on collections and constantly looking at ways to improve and be innovative and find different financial solutions and different products. So very much the same from last year, but a lot more focus into growth of businesses. And like I said, my team is solid, it's stable, and we're ready to take on the new financial year. And it would be remiss of me not to, first of all, thank the board and the leadership of Sasfin, who led us through very difficult times. And then not to thank our clients. We put our clients, it was a tough time. We had to have some hard conversations, but our clients have stood by us and supported us and continue to do so. I always say you can have loyalty in good times, but you see true loyalty and commitment and work and partnership and working together in tough times. So to just thank all our clients for standing and working with us through this difficult time. And then most of all, the most important is to thank my team. My team has gone above and beyond during this time. giving blood, sweat, and tears, working late, and being just showing the true commitment and living the values of Sasfin. So that's me. I'd like to now introduce you to Errol, the CEO of the Wealth Pillar, and everybody have a beautiful morning and a beautiful day. Thank you.
Thank you very much, Linda, and welcome and thank you, everybody. I'm going to start the wealth conversation on a slide about our assets. Everything in our business starts with assets, and really this slide just shows the trajectory of the growth of assets in Sasfin Wealth over the last few years. And I'm specifically going to focus in on the assets under management and advice. This is really our focus, is to increase those assets on which we earn an annuity fee. We've been transitioning this business over many years from a stockbroking or transactional business 20 years ago to more and more of a fund and money management business where we service clients in that way. So in that space, we had particularly strong growth in our institutional assets under management. These grew by 24%. We've had strong performance in this space, but we've also had very, very strong inflows in this space and continue to do so. We've made some big investments in people. We've made some big investments in distribution in this space, and we're really starting to see the fruits of those coming through. And in terms of some of those investments, in many of those, we're not yet reaping the rewards. We're still a little bit in the J curve in terms of that asset growth, where we've invested in a team across specialities, across products, and across channels who are only just starting to gain momentum, and we're seeing that momentum building on previous years. On the private client side, the trend of clients taking a bigger proportion of their savings into the global markets or offshore is continuing. I wouldn't say it's accelerating, but it is certainly becoming a larger and larger portion of investors' overall savings. So on the back of that, we saw about an 8% growth in our assets under management offshore, just to say that that's despite the fact that we saw material strengthening of the rand over the years. So this is in rand terms, this 8% growth that I'm showing over here. And on the local side, on the private clients, we were fairly steady. So we were a lot of clients who are converting a lot of their local assets to offshore, but through continuous inflows from clients, we've managed to hang on to that. Strong investment performance and really inflows and investment in distribution is what has been driving this. And you can see that the annuity portion of our assets relative to the transactional portion of our assets has been growing over time. Go to the next slide, please. This is just a snapshot of a very high level income statement. So at a very high level, our income was up just over 3.5%. We managed our costs very well this year with the uncertainty around COVID, managed to keep them flat. And with those positive jaws, we had an increase in our operating profit of around 19%. There's quite a lot of complexity and moving parts in that 3.5%. So I've just provided a little table at the bottom here to kind of unpack some of that. First and foremost is on the private client side, the foreign. You can see the increase in our foreign revenue. That's not made up only of assets that we manage. We do provide other structures and administration around offshore assets as well. And so if you bring that into it, our asset growth was actually better than the 8% that I was showing on the previous slide. And you can see that the revenue is increasing there in rand terms. And once again, against the backdrop of a rand that has strengthened materially during the year. On the local side, that decline is primarily due to a drop in our equity brokerage. This has been a trend over some time. We have seen our volumes lower, but more importantly, we've seen margins coming down. We do feel that we get into a bit more of a steady state on local brokerage at the moment. We feel that the market has got to a pricing level that is going to be a little bit more stable over the short term, although longer term, I think that pressure will remain. On the institutional side, really just reflecting an increase in revenue in line with the strong growth in our assets under management as well as advice, and then strategic investments. So within this line, that includes our minority interest in DMA. It also includes the investment in Efficient Group, which, as Angela indicated, we exited during the year. And I think we did report on that. We would have reported on that in terms of our interim results as well. In the other line, there's included in that other is a negative fair value adjustment against the land bank. and really the position in terms of this income statement or this revenue breakdown is that the gains that we have in terms of the salary efficiency that we made on that was really offset by this negative fair value adjustment on the land bank. And obviously it's a position that we're watching very closely to see how things unfold. Next slide, please. I've really spoken to most of the points on this slide. I mean, I'd just like to highlight on the right-hand side that, we continue to invest in people and process, distribution, technology, governance, etc. And I think all of these components have been important drivers in us experiencing and enjoying the strong net asset growth that we have seen. And we remain a top and strong performer. Just in this last year, once again, we've been recognized by the industry. The Sasfin BCI Flexible Income Fund has won a Raging Bull Award for the 3rd year running. And we've been recognized in the Morningstar Awards for the Sasfin BCI Balance Fund for the 2nd year running. And it's not just about investment performance. If we go on to the next slide, we are an award-winning business overall. If you start looking at the areas that we operate in, we've really been recognized by the industry and our clients, more importantly, across all of these. So we've, have many accolades over the years for performance, but in this last year, in the SA Top Stockbrokers Award, we achieved the top advice broker. So we were the winner in the top advice broker, and one of our stockbrokers was recognized in the top 3 as one of the best stockbrokers in the country, Helen Hayworth. To me, almost more important than the top advice stockbroker is placing top 3 in the People's Choice Award, because this is as voted by by our clients. So this is our clients recognizing the service and support that we give them. Also the Intellidex Awards, but moving on to the top Wealth Manager Awards, it's the first time we've entered these awards. We've been putting a huge effort behind our private client business and building out a more holistic and client-centric offering. And so it's the first time that we've entered these awards, and we placed in the top 5 for the best boutique wealth manager, as well as, once again, as voted for by our clients in the top 5 in the country. Thank you. Next slide, please. So really, I mean, going forward, what is the focus? For us, the number one focus is always people. We are a people business. Our IP is our people, and this is what we continue to invest in. So, we once again through this year managed to attract and retain some of the top talent in this industry. And it's not just investment professionals, of which we have many, but the complexity within a wealth and investment business these days means that you need to attract talent across all aspects of your business. We employ engineers, developers, and all kinds of specialists across this business to keep the engine moving. And we need all of these components to drive that next point, which is driving towards this more sort of client-centric approach. So big investments, continuing in people, but also in the technology that supports that service offering that we need to give our clients across the segments. Distribution and marketing, it's very important for us to leverage what we've achieved as a business in terms of the investment products and solutions that we've built up over time. We are really at an exceptionally sweet spot where we've got track record, good track record, strong track record, which is very credible in the market across our solutions. But we're still small enough to be nimble and to continue to provide our clients with bespoke solutions and alpha in the market. So it's very important for us that we get the message out there and that we get stronger distribution behind these investment solutions. In terms of offering, we are still very much focused on becoming a global business. We are looking for opportunities to expand our business globally. As it stands today, we manage more assets for clients offshore than we do locally. So strategically, it's very important for us, and it aligns us with our clients, which is exceptionally important to us as well. I've already spoken about the product offering and how we broadly, are broadening that to be more sort of client-centric and holistic around our clients. And then, we're a minority holder and it's arm's length, but we are working as well as we can with our strategic associate DMA to grow their business and to unlock synergies. We're seeing huge potential for them as there are structural changes in South African market, as well as opportunities offshore, shifting technology, shifting platforms, and we feel that DMA is exceptionally well positioned in this space, and we're very excited for what they're going to be bringing us next year and into the future. I think that is the end of my slides here. So I'm now going to hand over to the Group CEO, Michael Sassoon, who's going to take you through the capital and business banking pillars.
Okay, good morning, everyone. Thank you for joining us and for your interest in Sasfin. Sorry, can you hear me all right? Okay. Thank you for joining us. I just want to make sure that you can see my screen because I've just taken over the screen share. Can you show that you can see? Okay, thank you. I'll be talking to the capital and business banking pillars first, and then I'll come into the prospects thereafter. Historically, these pillars were very much two separate pillars, and our intention is to bring them closer together. And I'll explain more the rationale in a few minutes. But we are in the market to find an executive head or a chief executive of this area, so that really our business will be structured around our asset finance and wealth businesses. And as you've heard from Linda and Errol, these businesses are really firing on all cylinders, and they are operating at very healthy levels of ROE and at very good scale. And we've been investing in both our capital and business banking areas for some time. We've been repurposing them, and we're looking for an executive to now pull that together and help take it to the next level. Sorry. So let me just start off with Sasfin Capital. And just to remind everyone, historically, Sasfin Capital was very much a private equity business and a corporate finance business. But as a banking group with a relatively small balance sheet, we took a decision that we don't want to continue in private equity. And really, we want to focus this business on lending capabilities, lending to the medium market. And we've got different types of lending products which we can use to service that market, both in terms of term debt, off the back of property loans, as well as specialized loans and working capital finance. So if you look at the performance, last year we made this large loss in capital, which was very much a result of quite a big write-down in our private equity portfolio, given the challenging economy that we were in last year, which adopts a forward-looking view. This year, our property business, and we call it property equity there, but really in there's a lot of lending which is happening. We lend to different types of property ventures. Typically, we are well secured, and we take profit share or some form of equity upside. But really, the primary capital that we put into these businesses is debt funding. So that's also true of specialized lending. And both of those businesses, which are underpinned by secured or pretty well secured loans, demonstrated very healthy performance. And they both are relatively new businesses to Sasfin. So the real change in performance over here is coming from these two areas. Unfortunately, our private equity business, which we took a big write-off last year, continues to be a drag, even though it's showing a 12 million rand improvement year on year. That's off a very low base, and it isn't yet. Last year was a big loss. This year it's just it's flat or a slightly lower loss. Our trade and debtor finance business had a decent year, but its performance contracted. The credit performance has been very good in this business, but that business largely finances foreign supply chains, and foreign supply chains have been severely hit with COVID globally, and therefore the utilization of our clients has been lower, and we've lost a couple of clients, some intentionally, as we strengthen the credit risk profile of that business. Some of our longer standing investors will recall that business did incur some big credit losses a few years ago. Through the deconsolidation of HRS and commercial solutions, that did result in lower profits, and then there's some corporate services. So really, it's a good story for this pillar, which Francois has been running. He presented previously. He's stepping down as the head of this area. He will continue to do some work for Sasfin in a different capacity thereafter. At the beginning of next year, I just want to thank Francois for his leadership during this time, as he's led this business from what was a equity and corporate finance business into a credit-led business focused on the medium market. And you can see that coming through in the income. While the income is flat here, if you look at the mix of the income, the contribution from the property lending and the specialized lending businesses is significantly more. Private equity remains lower. The deconsolidation of HRS and commercial solutions did hit the income, but that also benefited the costs. And you can see there's been a big reduction in costs in this business, and the impairments have been lower given the very strong view we've taken, or the tight view we've taken on credit in this environment. I'm not going to talk much more at this slide. The only thing I want to highlight over here is that term lending book, which I was referring to, has grown 60% in the year to 688 million. Some of those loans are loans which we hold at amortized cost, which would have been in Andrew's earlier slides, but quite a few of those loans as well, about half the book, is loans which are subject to fair value adjustments because of the profit share participation. But really, just to reiterate the point, that the core loan is viewed through a credit lens. And we look at the serviceability and the capital of the businesses and the security which underpins those loans. We are looking to continue to exit some of our private equity assets. You would have seen our strong capital adequacy ratio. We're in no rush to do it. So we will do it as and when the opportunities arise. There's some good businesses in that portfolio, but that remains a focus. If I just now move on to the beyond business banking area. And this business was really our first entry into digital banking, which we went into a couple of years ago in 2018. And the initial approach into this business was a very efficient platform, which could be digitally, where clients could onboard themselves and service themselves on digitally. And we were one of the first banks to offer that for business accounts, and it's been a really good story. And then it was a low-cost platform, but the idea was that you would grow transactional deposits, which obviously there's a bit of margin improvement for the group in doing that. And you can see this significant increase in transactional deposits over the time. With the lower interest rates, we don't get as much benefit from this as what we would have liked. And now what we've been doing in the last year or so is building out the credit and Forex capabilities. While there's a lot of talk of digital banks in the country, I think in the business banking segment, unless you've got an appropriate credit offering, I think it is quite difficult to really win in this space, because businesses, many businesses do require some form of credit, and it makes sense for that credit and the banking to be housed in the same environment. So you can see there's been a very slight increase in income. This increase would have been much more had it not been for the lower interest rates, which did impact the business. As you can understand, the business does benefit from higher interest rates. As we start building a lending portfolio, there is some credit impairments. It's a new portfolio, so we tend to be very conservative in our provisioning as we learn a new portfolio. And while we're investing heavily in this business, we have managed to keep the costs relatively flat, because we integrated our Forex and banking businesses together, which helped us avoid quite a bit of duplication. So the loss is reduced slightly, but I think what's really pleasing about this business is that we're seeing those transactional deposits come through. We're not looking for 1 million customers. In the business banking space, if we can take on 10,000 customers or 20,000 customers who are activating their accounts and who are sitting with money in their transaction accounts, that makes a very big difference. And that will essentially take this business through a break even. So as I say, it reduces its operating loss through integrating the banking and the Forex. We're enhancing our client experience while extracting our cost efficiencies. We continue to digitalize the business, and I'll talk more about that in a couple of minutes. The other thing which we've started to do, and I'll also talk more about this, is that we are taking on more business bankers. While many clients, want to self-serve, and there is this need for digital, we see a lot of businesses who require a bit of hand-holding at certain parts of the journey. So we have taken on quite a strong team of business bankers, which we are growing. Linda touched on the Nasira facility that we've got, which is every month we see that the lending portfolio grow quite nicely in the space, and we expect that to pick up really in the coming months. All that being said, we're not growing yet at the level that we would like, and there's been a big focus on distribution. So then if I move on to prospects, let me just start off with transforming our society. And it really has been a very difficult 18 months. We 500 days plus in COVID, and the impact has been significant. Unfortunately, we lost one of our staff members earlier this year, which was devastating for our business. We're a small enough business that when someone when you lose a person, that impacts a lot of people in the business. Many of our people have lost loved ones, many of our clients, and I think everyone's been through this tragedy together. It's been a very difficult environment. Plus, a lot of our staff themselves have been very sick. We had 3 staff members who recently came off ventilators, which we're very pleased about, and that we wish them all well in their recovery. When you're building out projects and you're building out new businesses and half the team gets hit with COVID, that has a big impact, and people are largely working from home still. It's been a very tough environment, and to produce these results in that environment is quite something, and indicative of the exceptional people that we've got. And we've been very focused on supporting our people. So, for example, when the KZN riots happened and many of our staff in KZN weren't sure where their next meal was going to come from, we were able to get care packages, critical, service products that they needed, goods that they needed, down to them within a day. We've ensured that our people can work from home, and I think that we've done a lot for our people at this time, and our people have done a lot for our clients. And our clients have done a lot for us. And I think that that's really, when you talk about transforming our society, I think that's the starting point. We're very focused on enabling SME growth. We've got our Beyond platform, which is a great platform for SMEs, through the Nasira facility, which, to remind everyone, is a $15 million facility, or loan guarantee facility from the Dutch Development Bank, the FMO, which enables us to lend to smaller businesses, to youth-owned businesses and women-led businesses, and COVID-impacted businesses, which we'll be doing and growing that. So we're very committed to this journey for SME growth. We're becoming more focused on ESG imperatives. Sasfin Wealth has got into a partnership with an impact team. We are looking at energy efficiency finance, as Linda touched on, as well as affordable housing. And in our capital unit, we have funded some affordable housing opportunities, and we are working with the SHRA, which is the Social Housing Authority within South Africa, around really enabling increased access to housing for people who were financially excluded previously. We also have our partnership with Hello Payza, and that partnership is going well, which has enabled many clients and individuals who were previously excluded to access financial services. And we focus on transformation. We have an improved level 2 score and a level 1 score in our asset management business. Angela touched on the streamlining that we've done in our business. These steps that we've taken have all been significant transactions, which took a lot of time in the last year. Each one of them should improve capital allocation within the group and should improve our ongoing cost-to-income ratio. But most importantly, they enable us to focus on our core businesses. When you've got lots of different structures in a business and lots of different entities, you can take your eye off the ball. And in this last year, just closing out of these transactions meant that took a lot of time. But by streamlining, the intention is to focus on these 3 core businesses. And I'm very pleased to advise that at the end of this year, hopefully, we'll be moving into new offices. Our Waverley lease, which we've been in for the last, our Waverley premises we've been in for the last decade or more, comes to an end in May 22, and we already exited our Melrose Arch offices. We'll be moving to a combined head office, 140 West Street, where we will be meaningfully changing how we work. This building, it's a fairly young building. It only went up a couple of years ago. It's an exceptional building. There's very little work we have to do to it. The previous tenant that occupied our space put a lot of money into the space that we're going to be occupying. So it's not a big build at all. It's quite a simple renovation to make it fit for purposes for ourselves. We will be taking 25% less space than what we currently take. And as we expect, no more than 60% of our staff to work from the office at any one point. And based on the property market that we're in, we've been able to negotiate a significant saving on our cost per square meter. So we're very excited about this move. The other thing which is important to note with this building is we're not the only tenant in the building. There are other tenants, and that does give us some flexibility to take more space or less space as our needs might change in this changing environment that we operate in. And we moved our data centers off site. Our digital journey enables us to do this. Most of our staff are working from home at the moment, so it's not a complicated move, and we can quite seamlessly move to this new model. We believe it will enhance our total employee value proposition as people have to travel less. There will be a saving, for lower income earners. There's a material saving on travel if you don't have to work at the office each day of the week. We do see important, we believe it's very important to bring people together, but it doesn't have to happen all of the time. At the moment, we're hardly ever together, given the COVID reality that we're in. But in a post-pandemic world, we think that moving to this hybrid model will really work for our people and for our business. The way that IFRS 16 works, we straight line the lease, which means that we won't get that saving in the 22 financial year. In terms of the income statement, we will get the actual cash saving immediately from the time that the lease at Waverley ends, but the accounting benefit should start to materialize from the 23 financial year onwards. And then I started touching on this. I want to spend a couple of minutes on it. I see that we're coming to 11 o'clock, but we are really building this bank for business. And as I mentioned, each of these areas, Beyond and Capital, have built strong lending capabilities. We've built a strong digitally led and integrated product set, and we've onboarded quite a lot of expertise in business banking, lending, technology, and distribution. And just at a group-wide level, we've grown our distribution force threefold in the key areas that we want to grow this business in, across wealth, asset finance, and this combined area of business and commercial banking. And if you just then think about why we believe we'll have a right to win in this area, is that we will have something for each of for different segments, small businesses, medium businesses, and large businesses. We've got the right product mix. We'll be introducing an overdraft at the end of this year. We're going live with our Forex Online, our digital platform, Forex Online, in the coming weeks, which we're very excited about. We partner with fintech such as Payable to augment some of our offering. We've got working capital finance capabilities and trade and debtor, overdrafts, revolving credit facilities, as well as term lending. And then we have different distribution models. So we are able to acquire and service clients digital only to the degree that clients should wish. But we also have a team of generalist bankers in business banking and commercial banking, as well as real specialists who can structure and solution deals for clients. And I can't tell you how often I get a phone call from a medium business where the business says to me, we're with a bank, our banker left, we don't have a new banker, the branch that we operated our business through previously has closed down, they're trying to get us to use these digital platforms, I need credit, I need it quite urgently, I don't know where to talk to, I'm in a queue somewhere on a scorecarding model, and therefore we believe that while the digital capabilities at the heart of our offering are going to be very important, to be able to support that through a high-touch model where appropriate, especially as you move into the medium segment of businesses, which is really where South Africa needs growth to come from in terms of jobs, in terms of employment, in terms of growth. The importance of a touch model there cannot be underestimated. And it's something that, we've been on this digital journey now for a number of years. It's something which we see more and more. And then we work with partners. We've got our Hello Paysa partnership, but we are working with non-bank lenders. We work with Forex intermediaries. We work with, and we are open and we're engaging with different other industries as the world of business converges to support the growth of this area. I'm not going to spend too much time on each of these slides because of the lateness of the hour, but essentially this is more detail on what I've just said in terms of the offering and the distribution approach, as well as the lending capabilities and the digital element. Linda touched on the fact that we've gone live with a credit scorecard. We do lots of small loans in Sasfin. We've gone live with a scorecard where we've got some machine learning capabilities in the background of that scorecard. We are approving and paying out deals at a far quicker rate, which fit into our scorecard criteria. But where deals don't fit into our scorecard criteria, it's not like it's just a no. There's an opportunity to then evaluate those deals through a credit team, which are very seasoned. So just to make those points. And while we're building out this business and commercial banking area, we remain committed, and Errol and Linda articulated this well, that the year that asset finance has had in particular has been phenomenal. It's an exceptional business generating very healthy returns, as is Sasfin Wealth. And both of these businesses, while they are operating at scale, have got such room for growth. As we deepen the credit curve, we go into these new asset types in asset finance, and we offer other services to our suppliers, which we've been rolling out for the last couple of years, and we invest in distribution into these new areas. And in terms of wealth, as we do more offshore, we continue to build out this institutional asset manager, and we grow our distribution capabilities. And that really is a major focus. And as we bring in this business and commercial banking offering, to have these three areas operating, and hopefully we can kind of really take this business and commercial banking to kind of break even and beyond, which we believe we'll be able to do. Then we'll have a business which is operating at a very high ROE across the whole group. Our chair, Roy Anderson, indicated earlier that he will be retiring at the up-and-coming AGM, as well as our longer-serving non-executive director, Grant Dunnington. This is it's a new piece of legislation which came out from the Prudential Authority in 2018, where after 9 years, directors are no longer considered independent. I can safely say that both Mr. Anderson and Mr. Dunnington are fiercely independent in all their engagements, but they will be retiring at the AGM. Roy's been a fantastic mentor to me. He did oversee the transition from Roland to myself as CEO, and he's led our board and our company. He's added so much value over the years, and both Roy and Grant chaired our credit committee as well as many of other committees. They are big losses to the company. We have strengthened the board in other areas. I think Dion will add lots of value to our business, having previously been the chair of another bank. But with Roy and Grant going, we're trying to thank them both for their contribution and wish them all the best in their next journeys. And then just to conclude, as I said earlier, our team has gone above and beyond during these unprecedented times. And we've weathered the COVID-19 storm well. Last year was a difficult year, and we're very pleased with the results this year. Each of our pillars are well positioned to grow, and our team has done exceptionally well. So those are my final remarks. We've got a short video to give you a quick preview of our new building, which Elisheva will play now. And then if there are any questions, please raise them in the chat so that we can try and address them. And apologies to go on a bit after 11, but thank you once again for joining us. Elisheva, I'll hand over to you.
Michael, will you stop sharing? Thank you.
Okay, thank you, everyone. We are happy to take any questions. I haven't seen any questions posted, but if anyone would like to ask any questions, please feel free to raise a question on the chat. So while we're waiting, I'll just say that the one thing which has surprised me this year is just how resilient our clients have been. You know, we anticipated a far more difficult environment than what it's been. And as we see new deals come through credit and we do our client reviews, I think that business in South Africa is really, in general, there obviously been some sectors and some industries which have been very badly hit. And it's impossible, no matter how well you run your business, if you're in those environments. But we just see how so many of our clients have navigated the storm incredibly well. And I think it's a great sign for South Africa. We do fund and lend, at the real economy, and that has been perhaps one of the real upsides of this last year. So I just thought I'd make that point while we're waiting for questions. I don't see any questions. Okay, well, if there are no questions, thank you very much for your interest. Thanks for joining us this morning, and we wish everyone all the best, and please stay safe. Thank you.